Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in TradFi, digital assets, technology, and financial planning. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq market site is Russell Hackmann, president of Hackmann Wealth Partners, Chris Gaffney, president of World Markets at EverBank, and Ed Al-Hussainy, senior global currency and rates analyst at head of emerging fixed income research at Columbia Threadneedle Investments. They join me to discuss if the Fed's framework has evolved, path for long-term interest rates, and implications for the markets. It is great to have all of you with us. Welcome to Trade Talks. And of course, we can't remove ourselves from a conversation unless we're talking about how the Fed is evolving its policy, what's happening with inflation. Russell, we'll kick it off with you. What are your thoughts on the macro?
Generally speaking, I've been surprised to see that the Fed is sticking with this talk about cutting rates later this year. It seems pretty clear economically that if the government is spending $1.5 billion or $1.5 trillion, $2 trillion extra a year, that is inherently inflationary. The economy is very strong. I'm not sure rate cuts are justified. Plus, let's look at the fact that Powell's legacy is based on he let inflation get out of the bag along with some other people. And I'm not sure why he's cutting rates when it's not back in the bag, so to speak, or back in the bottle.
Yeah, I mean, that whole inflationary is transitory comment will certainly live with him for quite some time. So speaking of inflation, Ed, I mean, what is a reasonable target? Do you think we'll get to that 2%? Do you think the Fed is going to, jockey that policy?
I think we have a really good shot. I mean, look, to a large extent, the Fed's reacting to what happened to inflation last year, which is a significant decline, 7 and change, down to, let's call it 2.5 to 3% today. And so they're tweaking monetary policy really in response to that decline. Will we get that extra 100 basis points or so out of the system in the course of the next 12 months? I think we're really going to be sweating that for the rest of the year. But so far, I think they've been very consistent in saying like 2% is the target. Changing course at this stage is so damaging to our credibility that it's just not worth the cost. So we're going to persevere even if it takes the next couple of years.
Chris, does the Fed perhaps have to evolve its model or think about this differently?
I think they will, maybe not officially, but I think they'll accept a little higher inflation throughout the end of the year. I think they're going to cut in June just because they seem to be preset on a cut in June. They need to get cutting. Markets expect it. And there's nothing yet that has knocked them off that path to cut in June. If they wait, then it becomes a little political on delaying a cut. But they could cut and maybe pause a little bit, or maybe 2 cuts. 3 is going to be a stretch, I think, and we saw that in the last dot plot. We're real close to coming off the 3 in 2024.
Well, speaking of political, has election volatility hit the market yet? It doesn't feel like it. I mean, we didn't get our 6 cuts. We're potentially only getting 3. Earnings were good. I mean, it doesn't feel like it's volatile.
Doesn't feel like it. And to me, you have had, even though the markets are broadly up this year, you have had your share of sort of week-to-week volatility, and we really haven't seen anything from the elections like really moving the markets around. So there's a lot more to come this year, and you gotta bet there's going to be some of that.
Yeah, I mean, I'm surprised we haven't been talking more about what's happening with fiscal policy, never mind Fed policy.
The amount of debt, I mean, you brought up the amount of money we're spending, and debt service is going to eat away at the budget. I mean, it's going to become more and more prohibitive for the federal government spending as if those interest rates stay higher. So that's another, I know it's not their mandate, but that may be a backstory on why the Fed needs to get interest rates a little lower just to help ease the debt burden maybe a little bit on the government and on consumers.
And it really, I guess the reason it's not like much is so political is it seems like neither party has any interest in cutting spending. We were looking at, I was looking at something the other day that was suggesting that deficit spending in the last 4 months has been $500 billion, right? And so you look at things like that, and yeah, we want to get inflation down to 2%, but we're spending money like it's going out of style. There's potentially long-term pressure on interest rates going higher. So we've talked a bit about Fed interest rates and Fed funds coming down, but does the U.S. 10-year get below 4% anytime soon? I'm not so sure about that.
But a quick counterpoint. So last year, significant upside surprise to the deficit. The debt has continued to grow. the Fed shrank its balance sheet, and yet 10-year yields pretty much ended up exactly where they started, and inflation came down from about 7 to 3. And so I think there is definitely a scenario in which we continue to run large deficits. The Fed has to continue to provide a backstop to Treasury market liquidity in the form of a very large balance sheet going forward. But interest rates can continue to ease, largely reflecting the fact that inflation continues to come down.
Well, I think also we're the reserve currency. U.S. is the reserve currency. So international investors still use the U.S. dollar as safe haven and U.S. Treasuries as safe haven. So there's lots of demand out there, I think. So that's also kind of keeping a cap on rates out there on the 10-year. I mean, you know, there's always demand. There's always somebody that's willing to buy, and even with the amount of debt that we have.
Well, I mean, maybe this is a new normal. Right. I mean, for the past 10 to 12 years, we were living in such depressed interest rate environment, and the system was so flush with liquidity. If you look at it, mortgage rates from a historical perspective, we're right in line, right? So maybe this is
not an inverted curve, though. I mean, the short end's got to. I think they've got to push the short end down, or inflation expectations. I hope you're right, and inflation stays mild, and inflation expectations don't jump up, because that's really what would push up that long end, right? I mean, 10-year, if everybody started thinking inflation was going to run hotter for longer.
I think that there's always this underlying theme when it comes to the deficits and debt, that there's going to be an inflection point somewhere, and investors are going to realize that they need a much higher risk premium to own U.S. Treasuries.
Right.
Right, and we saw that briefly in the UK in 22, right when that market collapsed. Over the
European debt crisis. I mean, we saw it then.
The European debt crisis, where we had a real
Italy
credit risk
and
premium. And the question is that possible in a reserve currency in the dollar market? Is that possible when you have a Fed backstop? My answer is it's quite unlikely, but you've got to live with that risk in the background.
Yeah, well, you certainly do. Well, let's think about it from the market perspective and how it is performing. I mean, the momentum just seems to continue, hitting all-time highs, it seems like, every week. And then you have to start thinking about valuations, too, from a portfolio management perspective. Do you start looking at other sectors and other spaces outside of the AI and tech trade? I mean, there are portfolio mechanics.
The thing that's interesting to me, and the kind of work I do, is with kind of individual high net worth investors and thinking about, the path of markets, the path of, where do you put your money? And one of the things that, I've tried to figure out is, hey, this, if there is some pressure on the markets from what's going on around interest rates, can the equity market keep going higher? And I took it upon myself, because in a high service business, and in me talking one-on-one with clients, I don't see AI changing my life right now. But when I talk to friends and colleagues, and really anyone who's in like supply chain management, consulting, manufacturing, Jamie Dimon was quoted the other day saying, we got 300 projects inside JP Morgan to make things more efficient. It does seem like there's going to be some real productivity enhancements that sooner rather than later, that over the next 5 years could really bring up the productivity rate in the United States, which could counteract the impact of higher inflation and keep the stock market going.
Yeah, I mean, that's a good point that you make. We're seeing it daily, especially for supply chain. And think of all the issues that could solve from a global perspective. Speaking of global, anything ex-US that looks interesting? I mean, certainly the U.S. markets have been the place to be.
Absolutely. Equity-wise, I think the U.S. market is king, and it will continue to be the best place to invest for U.S. and international investors. And but there's, on the fixed income side or currency side, I think there's some opportunities. There's some interest rate differentials that certainly drive currencies, and there's higher real interest rates available in some of the other countries, Mexico, Brazil. There's some currency risk there also, but there's higher real rates available. The old spread trade may be coming back. I mean, the funding currency used to be yen or Swiss. Yen is at, it hit very low levels, and I think it's going to get a backstop from the Bank of Japan. Obviously, they're going to hold at 150. What was it, 152 or something like that? I don't think they're going to let it go much lower there. So we're seeing people interested in funding those carry trades, buying the low interest rate currency of Switzerland and investing in Mexico. We've seen that lately.
Yeah. Anything in this fixed income space as it relates to international?
Yeah, I mean, fixed income to me is super exciting. I mean, if you're a US-based investor right now, you kind of have a two-step decision. First, under what circumstances do you get out of cash? Cash is very attractive. You mentioned the yield curve is inverted. And I think the time is right now, because that reinvestment risk continues to rise as we see Fed cuts on the horizon. And second, the all-in yield across fixed income is reset much higher, just as a result of what happened in 22 and the aggressive Fed tightening cycle. So credit spreads, not very attractive at the moment, really reflecting what's happened in risk assets writ large, really, I think, elevated valuations at this stage. But all in yield, you're able to lock in income for the foreseeable future for the next 2, 5, 10 years at yields you haven't seen in the past 15 years. I think that's super attractive.
Yeah, well, you know, it's interesting. Prior to you guys coming on, we did a private credit panel, and part of that is institutional and retail demand because of the yields that you're getting on a longer duration. So from a portfolio perspective, Russell, are you hearing more interest in alts, whether it's digital assets as an alt, as an example, or, you know, other forms of private credit or private equity? Are clients looking for more of that in their portfolios?
In the market that I deal with, which is, you know, high net worth,
Right.
but let's say not ultra high net worth, not seeing a lot of demand for that. Like, our clients come to us and say, listen, you know, many of them are 50, 55, 60 plus. They're saying it's not an institutional business that I'm running, and saying, listen, I would just love to get some nice boring returns of like 5 to 9% for the rest of my life. And in incorporating that, there's a certain amount of equities that goes in there. Fixed income and bonds, I think, has been a real disservice, looking backwards at least, to individual investors. I still don't believe it's a great place for individual investors to have their money. And we look at people having different forms of principal protected upside, different ways of trying to participate in market growth, and as the point was made, around cash, right? You know, we're still buying 5.25% CDs and T-bills for clients, and I'm willing to bet that we'll be doing that at 4% by the end of next year, maybe even higher. And you know, if it's inflation plus 1% in cash for a while, I think that's good.
Yeah, I mean, 5 to 9% return. It's not every year that we start off and, you know, the Nasdaq 100 is up 8% in the first quarter alone, right? As we come to the end of the quarter, or exactly whatever percent it is right now, I think sometimes investors forget that markets do go up and down, and that's where that 8 to 10% average comes in. So it's not, I mean, 5 to 9% return is not bad, especially when you're
in cash. I mean, in an FDIC, we've got a savings account that's over 4 or 5% right now. I mean, sitting in an FDIC insured savings account. But like you say, will that be there 6 months from now? Or even a year from now?
Well, what's that mean for the market,
not.
right? If it's like here, then where does that money
Then
go?
it moves
then you're into the markets.
Exactly, that momentum.
For our client money, though, if it comes down from 5 to 4 to 3, I'm still leaving it there.
Yeah.
I think it's not a bad, and for cash, inflation plus 1% or a little bit more, I think that's great.
Yeah, let me frame it slightly differently. I think there's the opportunity cost of like staying in cash versus potentially extending your duration just a couple of years and being able to lock in that 6+% yield over, say, the next 24, 36 months. There's also, in the background, this notion of the Fed put. In other words, the Fed providing a backstop to risk assets, which in the last couple of years has been out of the picture. Inflation dominated Fed strategy. Backstopping risk assets was not on the table. Now that inflation's come down, the Fed put is back in play. And so again, if you're a risk investor, if you're looking at high quality credit, for example, you now have a Fed backstop to your investment in the way that you didn't have in the last couple of years. That makes it that much more attractive.
Right. So then if you have that, and then you have all this cash that's been on the sidelines coming into the market, especially the U.S. markets, it still seems to be that that's where you're seeing this growth.
And the U.S. economy doesn't look like it's going into the tank anytime soon. I mean, we're starting to grow again. Strong consumers.
I'm surprised by the strength of the consumer.
They're resilient. I mean, give them that.
Absolutely.
Yeah, I mean, even with the stimmy checks and all that, out of the equation right now, I'm surprised they actually lasted as long as they did too.
Right.
And if you look at some of the things that they're spending money on, like you have your autos and whatnot, but recently I was looking at a figure of several weeks ago. It's like restaurants and bars, like spending's way up, right? And that's just like the confidence that I have a few dollars in my pocket and let's have some fun, right?
Well, here's the theory. You have, it's especially in the first-time home buyer bracket, you have all this money that's being saved and you're just constantly getting outbid for homes. So, you have this cash sitting around, perhaps, or using that. Well, I could take another vacation this year. It's not like we're moving anytime soon, but I wonder if part of that is, there's just so much cash that has been saved and the housing market's not moving like it used to. So you have this cash sitting around.
Yeah.
Yeah, I mean, it's a question of how much stock do you put on that story continuing for the next several years, right? It might be slightly long in the tooth, right? On the margin, you are starting to see some distress. Lower income consumers, renters are starting to see a little bit of distress. The question in many ways is, can you look into the future and see an environment in which consumer spending continues to sustain risk asset returns? Or have we priced that in already? There's a fantastic amount of good news in the price. And so this is probably the right time to take out a little bit of hedge against something like a slowdown or recession, whatever it is on the horizon. Those odds today most certainly are higher than they were 12 to 24 months ago, right? And from a fixed income perspective, that's a super, super cheap hedge at the moment.
Yeah, I mean, we'll think about it towards the end of the year when everyone was expecting that 6th rate cut to happen in 2024, and the market ran off with that. And the question was, is that priced in? Apparently not, because the market's fine with not even getting, 3 at this point. And it also helps the earnings were decent quality.
There's still a lot of uncertainty globally. I mean, the wars and geopolitical risk, and then we're going into a presidential election.
I think there's 67 global elections this year.
Yeah.
There's a lot of uncertainty out there. I don't see that necessarily priced into assets, and I agree with Ed that a little bit of insurance, a little portfolio insurance, if you will, is smart, and have something that everything's floated up. I mean, all the boats have floated up with the expectation of lower interest rates across the globe. So we've had an everything rally here for a while.
True. Yeah.
Right now I think it's probably smart to get some insurance for those. I mean, it was just one bridge, but what else is out there? The black swan event. It's smart to have a little portfolio insurance, catastrophe insurance.
Well, you don't want to buy it when your house is on fire. That's the old expression.
Right.
Absolutely right.
Yeah. Well, I mean, if you want to go into the volatility conversation right now, it's so depressed. It's cheap.
Yeah.
And you know how it is in volatility markets. When it's at these 12, 13 levels here, when it moves up higher, it really moves up higher.
Yeah. It feels like we're a little bit overdue for one of those surprises. Yeah. And I think, agreeing with everyone here, that a little bit of insurance, a little bit of right-sizing your exposure to risk assets, that makes sense. Yeah.
All right. Well, we will leave it on that note, gentlemen. Appreciate the insight. Thanks for joining us on Trade Talks, and thanks for joining me from MarketSite. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.